Thank you, everyone. First of all, I want to say I'm just thrilled about this award, but I really don't deserve it. It's the financial crisis that gets the award. Honestly, I've been working on financial markets for many, many years, and then all of a sudden this crisis came along and everybody wanted to hear about it, and the alumni groups included. Had it been, let's say, a pandemic or of some sort of like H1N1, you would have seen Professor Larry Wine up here. Or if it had been a constitutional crisis, you might have seen Keith Kriebel or Dave Brady up here. But this year it happens to be financial crisis, so I get this award. Thank you very much for the award. And because of it, it's my responsibility to tell you a little bit about what's been behind this, that is, this financial crisis. It's not only my responsibility, it's my great pleasure, because it may not be apparent to you, but it's really what professors love to do, is to talk about their research, and this is an area in which I do research and teaching. So what I want to do is, over the next few minutes, leaving plenty of time at the end for me to hear from your questions, is to kind of lay out some of the key events and where they have left us now. Short meaning we have a lot of work to do to make sure that this doesn't happen again, or at least if it happens again, we will have at least done our best to make sure it doesn't happen the way that it happened this time, and somebody else will take care of the next one. So I'm going to talk for a few minutes, and then so get your questions ready, because I'm going to count on you. I'm not going to take up certainly more than half the time, probably less than half the time. So the fun part, for me at least, comes at the end. Now, as you know, about 2 years ago, a lot of subprime mortgage borrowers didn't pay back their loans, and some large mortgage financing companies like Countrywide and New Century got into serious trouble. That caused significant losses that surprisingly didn't really have a big impact on the stock market or on investor fear for some time. But then last year, as you know, things started to get quite serious. In March, the big investment bank, Bear Stearns, failed due to a run of a form that I'm going to talk about. Not a traditional depositor run that you've seen photos of during the Depression, but a run of various kinds of capital market counterparties that I'm going to describe. That's kind of the intellect content for today's talk, but the rest of it is color commentary. Now, it's a sort of a scary topic for the end of an afternoon of an alumni reunion, but anyway, there is some content here. Now, as you know, the scariest month of all was September of last year, beginning essentially with the failures of the two huge mortgage agencies, Fannie Mae and Freddie Mac. The government had to take those over because they were bust. Then, shortly afterwards, on a weekend, Lehman was about to fail. During that same weekend, Lehman Brothers is a very large 150-year-old investment bank. During that same weekend, Merrill Lynch apparently was going to fail and had to be taken over by the Bank of America. On the Monday morning that Lehman failed, declared bankruptcy, there was a run on money market funds in the United States. Now, that's not a well-known fact, but there was, starting with the reserve fund, which is a fund that had invested in Lehman securities, there was an increasing amount of funds being taken out of money market accounts around the country. And the Federal Reserve and the Treasury decided something had to be done, and the government insured money market funds that week. Meanwhile, it became apparent that AIG was going to fail, AIG being one of the world's largest insurance companies. The government had to step in and give $85 billion that week to AIG to keep it from collapsing and possibly bringing down some of the banks that had relied on it for insurance. That same week, rumors started to circulate that Morgan Stanley, which fortunately did not fail, was in deep trouble because many of its clients were leaving in droves. And we know now, because the facts are now coming out, that there was a significant loss, I'll describe that in a few minutes, of their ability to finance themselves in the same way that had caused Lehman to fail. People were even using the term, could Goldman Sachs also go? Now we know Goldman Sachs is now one of the healthiest banks in the world. So although it's been only a few months, it's easy for us to forget what a serious week that was. It was a very short week, but a very severe week. Later that month, two of the nation's largest retail banks, Wachovia and Washington Mutual, also failed, had to be taken over by the Federal Deposit Insurance Corporation. On September 29th, still the same month, Congress was presented a 3-page draft piece of legislation from Hank Paulson, the Treasury Secretary, asking for $700 and some billion to finance a bailout of the financial industry. I remember sitting at my desk as the votes on the floor of the Congress came in against that bill, and as they started to be tallied in Congress, you could see the Dow Jones average ticking down vote by vote. It dropped 500 points during the course of that vote on the House of Representatives. Eventually, as you know, by October 1st, Congress did pass a version of that troubled asset relief program, $700 billion of financing for the financial industry. Now, after some fits and starts, they actually started to use that money to recapitalize some of the weakest banks. And later, they used some of the same money for GM and Chrysler and some of the smaller banks. In 1 week in October, the Dow Jones average lost 22%, its worst ever performance since the Great Depression. And the stock market at that point was down 40% from its high only a year ago, only a year before. Stock market volatility reached the level of 60% for sustained periods. It had never done that. Momentarily in the 1987 stock crash, volatility in the stock market exceeded 60%. But for the first time ever, it was sustained at such a high level. That's 4 times the normal level of volatility in the stock market. In total, stock market investors had lost globally $8 trillion, far more than the losses on subprime mortgages. So this had become a global financial crisis. Now, since last fall, although the stock market got even lower, thanks to the last resort financing by the Fed and continued support for the economy and the financial sector by the Treasury and by other governments, markets have stabilized. Earlier this spring, the government tested the banks in what was called a series of stress tests, announced that they were satisfactorily capitalized, and on that basis, those banks were, the weakest banks, were able to raise significant amounts of capital, private capital in capital markets. And that surprised, the positive effect of that surprised many, including some in the administration, from what I can tell. The stock market subsequently, as you know, rebounded strongly. Housing prices have started to go back up across the nation. They're still, by the way, about 50% higher. Housing prices in the country are still about 50% higher than they were in 2001. So maybe this is a good time to declare this crisis over and look ahead at our preparations for the next one. Is the crisis really over? Let me ask that question briefly. We're not necessarily completely out of danger. According to the International Monetary Fund, banks have written off about $1.3 trillion in bad loans because of the subprime mortgage-related losses. But they still have about $1.5 trillion of write-offs on bad loans to go. So there's a serious problem in the banking industry. They're continuing to raise funds, but some banks are very weak. Among the big banks, the ones that are dangerous to the rest of the financial system, the too big to fail ones, only Citibank is in deep trouble, in my view, but it's on life support from the federal government, which has pumped $45 billion of capital and has guaranteed the performance of $300 billion of Citibank's assets. So Citibank is not going to crash and cause a big problem, but this is the kind of bailout for which we need to make better preparations. We don't want the government to have to step in and spend so much taxpayer money next time. We want to be prepared to allow these large banks to fail without dire consequences to the rest of the economy. We still have an unemployment rate of around 10%, which is a post-war high. That is at this sustained level. Between a fragile banking system and a very weak economic growth for the next few years, positive but very weak, I don't think we're entirely out of trouble, but the most likely path is that we will continue to recover, that we're on a stable, low-growth path for some years to come. One might be concerned there's, in fact, given the run-up in the stock market and the fact that people generally believe that we managed to get out of this crisis in reasonable shape, I'm a little bit worried that people are relying on the central banks and governments of the world to fix these crises as they come up, and that we will not fix the infrastructure of the financial system so that we don't leave it to chance and maybe good luck and some smart people being in the right place at the right time, but rather we just have a more robust financial system the next time around. And what I want to do, and this is kind of the sort of hardcore for those of you that are into hardcore finance, is the hardcore part. I want to talk about what we do need to do about keeping these large dealer banks in a more safe and sound condition. Now, when I say a large dealer bank, those are banks that not only may have commercial banking services like Citibank, JP Morgan, and so on, but they also have businesses making markets in securities and in derivatives and serving the needs of hedge funds as clients and doing asset management for large institutional investors. Many I can see are in this room. So these banks run very large, complex financial businesses, but the point of instability that we discovered during the financial crisis for banks like Lehman, Bear Stearns, the near call at Morgan Stanley, and the other very large dealer banks had to do with the backbone capital market operations in 3 areas. I'm going to test you on these afterwards. One area is derivatives. I'm sure most of you have heard about these. I'm not going to talk about them in detail. How many of you have heard about repurchase agreements? Just to get an idea of my audience. Oh, quite a few. Okay, so I got a pretty sophisticated audience. I can race ahead. Those are the 2 of the areas, derivatives and repurchase agreements, which are short-term loans to these banks that allow them to finance their securities. The 3rd area is called prime brokerage. This is the business by which these banks handle securities and cash for hedge funds and help them execute their trades, keep their accounts, provide them with reports, accounting, risk management, and so on. Now, these prime brokerage clients are also a source of instability. All 3 of these classes of counterparties to these large dealer banks will rush for the exits when these banks start to look distressed. And they will accelerate the onset of a default by these banks. Just in the same way, if you've seen photos of depositors lined up during the Great Depression at a bank that was in trouble, those depositors would line up for cash because they were afraid that if they didn't get fast enough into that line, that someone else would get the money out before they did. And by the very act of withdrawing their money, they accelerated or even caused the failures of those banks. Now, as you know, in 1933, the government instituted deposit insurance, federal deposit insurance. So we don't need to worry in this country about traditional deposit insurance deposit runs on banks. But this is the 21st century. We have these large repo, derivatives, and prime brokerage businesses that can run, and when they do, they can also do the same thing. They can cause these banks to run out of cash and not be able to meet their obligations and fail, even if the banks might, in principle, be solvent if you were able to sell all of their assets in an orderly manner. Now, I want to run through this very briefly, these 3 sources. First, I want to talk about repos. These are very short-term loans, typically overnight, by which these large dealer banks finance their inventories of securities that they hold for their own investment and for purposes of making markets. Now, if the hint of weakness at one of these large dealer banks like Lehman hits the market, anyone that's lending money to Lehman can simply say, why should I continue to lend money when I could walk away? Even if my loan is secured, as a repo loan is, by holding securities from Lehman, why would I put myself in a situation where I have to go through a workout through bankruptcy? I can simply tomorrow lend that money instead to JP Morgan or some other bank. Now, if those short-term lenders decide not to roll over those loans, then the bank has to find additional cash financing, and its sources of cash are disappearing at a time like this. It may have to sell securities into a falling market sometimes called a fire sale in finance. And that itself can be destructive of value. It can also cause knock-on effects through the rest of the economy. As banks sell more and more of these troubled assets, the prices get lower and lower, and that causes everybody to be in the same boat. So regulators are working on ways to prevent these runs by repurchase agreement counterparties, that is, by these short-term lenders, but they haven't solved that problem yet. Now I'm going to talk about derivatives. You all have heard about what they are, but you may not be aware that if I enter into a derivative contract with Bear Stearns or Lehman or Morgan Stanley, then I must post collateral with them, meaning a cash guarantee that I will perform on my contract. If I become concerned that one of those banks may not make it, I don't want to leave myself in harm's way. Maybe they won't perform on the derivatives contract. Maybe I'll have trouble getting my cash back. So I will take my contract and move it to another bank, a safer bank, and I'll take my cash with me. And those banks will lose a source of financing. And you might say, well, how would that cash that I've left there as collateral be used for the banks, by the banks to finance themselves? Indeed, the banks are able to use that cash collateral for their own purposes. They owe it to you, but it's not segregated. They can buy other securities, lend it to other customers, and so on. So by leaving en masse, derivatives counterparties can reduce the source of cash available to these large dealer banks. This is another kind of run. The third area that I mentioned is prime brokerage. Prime brokerage means, as I mentioned earlier, hedge funds or other institutional investors are provided services by these large dealer banks basically in securities transactions. That's the most important service that they provide. And when a hedge fund is working with Lehman or a Bear Stearns, which were very active in this business, they would typically leave their cash and securities on deposit at the dealer bank, Lehman, let's say. Now, in the United States, there are some restrictions on the ability of Lehman to use those cash and securities left on deposit with it by hedge funds. There are some restrictions on the ability of Lehman to reuse that cash and securities for its own business under the Securities and Exchange Commission 15c3 rules. However, by a rather arcane series of transactions, there is nevertheless a substantial source of funding available. When I post my securities at Lehman, it can then lend them to another investor in the economy or use them as a collateralized loan to a certain extent, subject to SEC rules. Just to give you an idea of the degree to which a run by prime brokerage clients could remove your ability to finance yourself, consider the case of Morgan Stanley. Now, because it survived, we actually have its numbers before and after of how much securities that were left with it that it could use to finance its own business. In the report that it provides before Lehman's fail, $900 billion of securities were left with it by others that it could use to finance its business. In the first report available after Lehman failed, less than $300 billion. So a $600 billion reduction. Now, that doesn't mean $600 in cash, because in order to be able to pledge those securities, they had to provide cash to some extent to their hedge fund clients. Nevertheless, a substantial source of loss of liquidity because of the departure of those hedge fund clients, which almost, according to some accounts, ruined Morgan Stanley's business. If you read a new book that just came out this week, I got my copy on the first run, by Ross Sorkin, a New York Times reporter, called Too Big to Fail, or you read his teaser article a few weeks ago in the Vanity Fair on the week that Lehman failed about how Morgan Stanley's business was suffering from departures of prime brokerage clients, you might be frightened. For example, Morgan Stanley started that week with $140 billion of available cash, and it ended the week at $30 billion of available cash. It was going down $20 billion a day during some of that week. The United Kingdom has no restrictions on the use of securities, and it still doesn't. I think that's something that needs to be fixed, and I think the US rules could also be tightened up somewhat. The derivatives legislation that needs to be, well, as you know, there's a series of bills before Congress right now on how to fix the over-the-counter derivatives market with respect to things like clearing, which is guaranteeing that these contracts will perform by a third party. This legislation is under tremendous amount of pressure from both sides. Some of the lobbying is improving the legislation, some of the lobbying is not improving the legislation. I've been to Washington several times in the past year on these derivatives legislation issues, talking to people in Congress. I'm going to go again next Wednesday and talk to the Senate Banking Committee. And I can tell you that it's completely unclear right now how this is going to come out. So in the repurchase agreement area, in the derivatives area, and in the prime brokerage area, there is a lot of work to be done. The Obama administration has also proposed legislation for how to wind up, that is to resolve a failing financial institution without necessarily letting it go into bankruptcy. And the House Judiciary Committee met yesterday to debate how that's going to be done. That's still quite up in the air. And there are some serious problems in getting financial design that allows these large financial institutions to wind up their affairs in an orderly manner. None of the legislation that's been proposed so far, I think, is going to accomplish that. I'm making some proposals, and some other economists are making proposals for having a contractual automatic restructuring of the balance sheets of these banks when they become distressed. So the idea is there's a bit of fine print on the back of a bond contract or an equity contract that says in the event that this large systemically important financial institution gets into difficulty, hit this button, and for example, in the case of a debt contract, the debt obligation will be replaced with shares of equity at a certain ratio that will allow the bank to get recapitalized without having to go through necessarily a bankruptcy. So I think that's not a panacea, but I think some thoughtful, non-disaster related automatic restructuring of these financial institutions could be very, very useful. Now, in all of these areas, these are not going to take care of simple issues of management. I know that any of you that are not involved in the financial industry, many of you, because you came through Stanford Business School, are heavily involved in management. Many of the failures that we saw in the financial crisis were simply management problems. For example, at AIG, if you read the article in Vanity Fair by Michael Lewis, had a very severe problem with its senior management and board of directors not understanding the huge risks that AIG was taking in a very concentrated type. If you go to, for example, Bank of America, one of the nation's largest banks, at the peak of the financial crisis, there were no non-management members of the board of directors of Bank of America that had professional experience in the banking industry. Bank of America, as you know, took a lot of risk when it bought Merrill Lynch, and the CEO has now been slated to leave. I think having boards of directors of large systemically important financial institutions with more expertise in finance might be a very good idea. Now, I've mentioned some of the things that we can do about this sort of a financial crisis. What about the ones that might happen next? I want to finish on that note. What are they likely to be like? Well, we actually have a pretty good history. There's a wonderful new book by Carmen Reinhart and Ken Rogoff on financial crises, a history of financial crises. They go back 200 years. And it turns out that for the last 200 years, on average, the United States has been in a financial crisis about 1 year out of every 8. For the United Kingdom and France, the average is about 1 year in 10. And countries with very large financial centers, like London or New York, tend to have financial crises more often, and it's not surprising why. Now, Lord Turner, the head of the United Kingdom's Financial Services Authority, has suggested that maybe it's not a good idea anymore for London to be a financial center, and that they should tax financial institutions so heavily that they become that they reduce the size of their financial sector. I seriously doubt that that's the right way to go. I think we want to improve the robustness of the financial system, but not necessarily get rid of the financial system as we know it. Anyway, I doubt many countries would be interested, perhaps except France, in getting rid of their largest financial institutions. Now, in these last 200 years, where do these financial crises come from? Well, Carmen Reinhardt and Ken Rogoff find that most often they're associated with bank losses on real estate loans. The next most common causes are sudden collapses in commodity prices and with liberalization of financial markets regulations. So it seems that we had a few of these things going on. Those are the three most common causes. We've got sort of the perfect storm, or the mother of all financial crises, it seems. So I would certainly start by fixing the problems that I just described. Now, we could go back and talk about the genesis of this crisis and how it was that people took so much risk and moral hazard and compensation issues and so on. That's not my message today. My message today is inevitably we're going to get these crises, but we want to make the plumbing of the financial system much more robust so that when these losses occur at one large bank, they don't get transmitted through the financial system to other large banks. That plumbing needs to stay relatively clear. As I mentioned, the losses in the subprime area were on the order of $1 trillion. The losses to the entire global macroeconomy have been estimated, on the stock market alone, about 10 trillion, but more broadly, many more trillion than that. As for what might be completely different next time, well, the world is changing. We rely a lot more on electronic infrastructure. Some of you may not know that we had a close call on 9/11 when the Bank of New York, which is one of the two, in fact, it's the largest clearing bank in the world. It handles backbone cash and treasury transactions for a large fraction of the market. It went down because its electronic telecommunication system was broken by the attack on the World Trade Center, and there was close to a panic in the money markets by which banks fund each other overnight. But that was averted because the Fed acted very, very expeditiously. But we have an increasingly electronically interconnected financial system, and we want to pay extra close attention to security because who knows, maybe that's an issue that could come up in the future. Another issue that concerns me to some extent is that financial crises tend to happen also at times of major global currency market instability. Now, we've had a long run of stability in global currency markets because the United States has the global currency, the only currency that's generally accepted in large volumes for backbone transactions around the world. One of the reasons that the euro, which is an equally highly demanded currency for retail purposes, is not as big of a backbone currency, is that it doesn't have a single government bond market. It has many different government bond markets, one for each country. But the United States, for good or bad, has an immense government bond market. And as you know, countries like China and many other countries use U.S. Treasuries as their store of value for many purposes. So the United States has a kind of franchise going on its own currency. It gives us a huge advantage. But we can't count on that being there all the time. And if there's the next time that there's a financial crisis, if there isn't a safe haven, which is the US dollar, where everyone can go and duck and cover, that could be a source of concern. As you know, the interest rate paid on US Treasury bills went negative during the financial crisis because everyone wanted to own Treasury bills, and they were willing to lend money at negative interest rates in order to get those Treasury bills as a safe haven. Now, I said I wouldn't go on too long, and I hope I haven't been too scary, but I'd like to open it up to questions from you all, and we can have some fun discussion. Maybe you can make a lighter story out of this. So I'll try, I guess I'm moderating this, so I'll try to go around. Are we going to use microphones in the audience, or am I just going to repeat the question? I'll try repeating the question. So I'm going to start with the gentleman that had his. Yes.
The financial markets have had independent institutions like, okay, the financial markets have had independent institutions like the Depository Trust Company or the futures exchanges, which have acted as settlement intermediaries for those markets and have basically taken away counterparty and settlement risk for those markets and maintain collateral in the futures markets. Do you have any suggestions as to how what is now the over-the-counter derivatives market could come up with an analog like that?
Yes, I do. In fact, that's what I was testifying to the Senate Banking Committee about last summer. There's a thing called a central clearing counterparty, which is exactly the analog that you spoke of, but it operates in the over-the-counter derivatives market, and it does exactly what you proposed. Instead of me being at risk to you, I would call Dwayne and I would say, Dwayne, could you stand in between us so that if he doesn't pay me, you'll still pay me, and if I don't pay you, if I don't pay him, you'll still pay him. Dwayne's going to guarantee our contract. That's what a central clearing counterparty will do, and he'll charge a fee for it, and he'll ask us to post collateral with him, and he'll have uniform standards, and he'll stand in between these systemically important financial institutions to make sure that if one topples over, it doesn't bring the other one with it. There's been a huge debate over the structure of this market, but Congress has decided that it will favor the placement of over-the-counter derivatives in those clearinghouses. Now, that will not take care of an AIG problem. The AIG derivatives were exotic. They were customized. And if I called Dwayne and I said, Dwayne, I've got these AIG type of credit derivatives, can you handle those? Dwayne would say, no, that would put me at risk because I don't know how to price those on a daily basis. And if I was to fail, if Duffie was to fail, Dwayne would not be in a position to be able to unwind those positions very easily. So that would put him at risk. And that would, because he's systemically important now, that would put us all at risk. So those central clearing counterparties can handle the plain vanilla standardized contracts. They can't handle the others. And in my view, we shouldn't kill off the others entirely because there is a lot of useful customization that corporations need to do. But we should charge the banks a higher capital charge if they're going to do those customized products to make sure that they have the capital to stand behind them. So that's my answer, sort of a long answer, but that's the answer to that one. Now there's a gentleman just in front of the video camera. Yeah, in the white shirt.
What do you think would have happened if the government wouldn't have backed the insurance of those credit default swaps for AIG? Because I think that a lot of people think they would have left that alone. It may have solved itself, but you probably have a
I
better
asked a few people about that, and, including some people at the government, and the answer that I got is if we had had a little more than 24 hours to think about it, we could have done it a lot more cheaply. The government was concerned not so much about AIG, but about the fact that AIG was offering insurance against subprime mortgage losses to various banks, and it was concerned those banks would suffer so much. So with hindsight, in fact, not very much hindsight, the government should have said, we will guarantee those insurance contracts, but we're not going to guarantee AIG. We're going to cover the key insurance contracts. So maybe we're going to lose $10 or $20 billion, but we're not going to lose, now it's up to $150 billion. Now we may get some of that money back, but my guess is we're going to lose quite a few more billions than we needed to have lost. And that, we didn't have the proper oversight, management, corporate governance, risk management, and because of that, we weren't prepared, and we had to move on an emergency basis. I can understand the government making some mistakes on an emergency basis, and we just want to make sure that next time we have more advanced planning. Got lots of questions. I'll start with this gentleman right here with the sweater.
What do you think of Paul Volcker's proposal to reenact Glass-Steagall?
The question was, what about Paul Volcker's act to reenact Glass-Steagall? By the way, Mervyn King, the governor of the Bank of England, has proposed something very similar. I think it would take care of a lot of the problems of commercial banks failing because they're attached to investment banks like Goldman Sachs or Morgan Stanley, but I don't think it's going to cure the problem. It would help somewhat. It would also make commerce a little bit, have more friction than I think it should have. So overall, I think we can do better than that. If it was the only thing that was available, I would go for it, but I think we can do better than that in terms of keeping the capital markets as efficient as possible. All of the measures that have been proposed, including the ones that I have proposed, are going to require more capital to keep the financial industry going. That means the financial industry is going to be more expensive. It'll take more capital to process the same transactions. Return on capital will be lower. That will slow down the economy a little, a price we need to pay. But we don't want to, in my view, throw capital at every problem until the point at which the financial industry is so inefficient that the trade-off goes the other way and we're losing too much economic growth because this plumbing the pipes are too small, basically. That's my concern. But as I said, it's a thoughtful and and worth considering idea. The gentleman here in the black T-shirt.
Right now, as the banks strive to maintain their profitability and the government is working on consumer protectionism, how do you see those two, they're conflicting with each other, and how do you see that impacting the banking business going forward?
Well, yeah, as you know, the banking industry is lobbying very hard to prevent the new Consumer Protection Agency from coming into place. And I have to confess, up until I visited Washington for the last time, which was about a month ago, I was against this new Consumer Protection Agency because the Fed, the OCC, the OTS, the Office of Thrift Supervision, and the FDIC all have responsibilities in this area. And I thought, wow, we don't want another government bureaucracy. They already have this covered. And then when I went to this meeting, I was convinced by a presentation in which it was made clear that these other agencies have many conflicting objectives, some of which are, consumer protection is not as high on the list as it might be. So I have become a convert. I'm in favor of adding another federal bureaucracy to protect consumers from unsafe or unfair practices by banks. Now this one, as opposed to what I was talking about, which is systemic risk, this one is in a different area. This is like a drug, the FDA protecting you from getting inappropriate drugs from over the counter or from retail. And my views on this are separate from what I was saying before, but I think it is a good idea, and I think it's a traditional special interest. On the one hand, consumers want their interests protected. On the other hand, the banks want to remain as profitable as possible. And both have good cases to make, but I come down in favor of this Consumer Protection Agency. Yes, sir, in the jacket right here. Yes.
You weren't pointing directly at me. At any rate, the question is, short of complete failure of two of the largest banks, Citi and Bank of America, is there a almost middle way in which the federal government could restructure, take over those two banks, restructure them, and give them a brand new charter to deal only in local, state, and federal securities, and thereby secure the capital structure of those two banks, split them up in effect, and make them into much more manageable, give them a regional venue, and so on. But the whole competition between Citibank and Bank of America got to be so vicious that that's why Bank of America stepped out of line and bought that mortgage company, forgotten which one it was. Countrywide, and the brokerage company. It was the egos of the managers, the owners and CEOs, that got those two banks into severe trouble. Absent that kind of management, would it be feasible for the federal government to take them over and restructure them along the lines I just suggested?
Well, in the case of Citibank, it sounds like your game plan is essentially you must have given it to the government, because that's roughly what the government is doing right now with Citibank. They have a very large fraction of the equity of Citibank, and they have been putting pressure on Citibank to essentially dismember itself, selling off any businesses that it can sell off in order to raise capital, to eventually downsize and focus on its more on its core competence. I'm not familiar with the personalities involved, but the former CEO of Citi, Chuck Prince, indeed, consistent with your the basis of your question, said, the idea is as long as the music is playing, we continue to dance, meaning that if we're competing against others and they are taking on more and more of businesses that may not be long-run profitable, but we have to do as well in order to show that return on our accounts, then I think that he was referring to that competition that you spoke of. But I think that kind of behavior is now, at least until our memories fade and the next crisis comes along, that kind of behavior is not going to be either tolerated nor adopted. The case of Bank of America is quite different. They may have had some management problems, as I spoke of before, but they haven't been told by the government that they need to be dismembered or downsized. The government is waiting to see whether or not they can come out of this on their own. So I think the government is more in that case standing on the sidelines. Yes, sir, right here.
How would you measure bubble formation, and how would you measure the timing of burst points?
Yeah. Well, if I knew that, as they say. Okay, so the question was, how do you measure the formation of bubbles, and how do you foresee the time at which the bubbles burst? I have to tell you that I find this very, very difficult. Economists are worse than anything else at timing. So seeing when they're going to burst, you can forget about that. In terms of seeing the formation of the bubbles, whenever you see very, very low costs for borrowing, and you see large capital flows going from one country, like China, to another, like the United States, watch where the money goes. And probably that asset class is getting too much investment. The risk premia are shrinking, and there's an encouragement to take more and more risk. Now, did I see that? No. But my colleague at Yale, a friend of mine, Bob Schiller, gave a talk in the room next door, actually room 162, right over there, about 2 years before the financial crisis, and made a very compelling case that the price of US real estate had been bid up to unsustainably high levels relative to the services offered by housing real estate in comparison with other measures like how much does it cost to rent a house as opposed to buy it. Those two numbers are always going to be different, even when one is capitalized on the same basis as the other, because people like to own versus rent or vice versa. But the ratio between those two prices had gone completely out of whack in the previous 5 or 6 years. And he was right, but nobody else saw it. He and only a few other people were either smart enough or had spent enough time with the numbers to actually scope it out. And that's where fundamental investing, and I know many of you do that, comes in. It's you guys are all responsible for keeping those prices in line. Yes, sir.
You focus your remarks on the liquidity issue. If there's a run on the dealer brokers, but we had two problems. One was liquidity, but the more fundamental one was the valuation and the leverage. And in 2004, the SEC changed the regulation of the leverage available to the top 5 dealer brokers by going from just the ratio of assets to equity to the sophisticated formulas based on rating agencies, which you all know are based on false statistical analysis today. But you haven't talked about that.
Yes.
What do you think about that?
Yeah, I picked up the story after the banks had already become weakened, and I sort of followed the entrails to the point of failure from point of weakness. But what caused them to become weak was, exactly as suggested, they took too much risk relative to their capital, and that was allowed, particularly among the US investment banks. The European regulators have been saying all along, we don't think that Bear Stearns, Lehman, Goldman Sachs, and Morgan Stanley are properly, their capital is sufficient. And the SEC said, as you suggested, well, we have these capital requirements. And Hank Paulson testified to Congress the week before Lehman failed, literally the week before Lehman failed. And Chris Cox, the head of the SEC, testified before Congress, literally the week before Lehman failed, that they had adequate capital. And it was Chris Cox's responsibility, and I actually met with him recently. He was very honest and straightforward. He said, that was the best numbers we had, but obviously they weren't good enough. So the way that these numbers are kept is insufficient. It's not adequate. We need proper mark-to-market accounting, and we need much tighter controls on leverage. I want to repeat, there's a lot of mistakes are going to get made, and these banks are, even if we fix the leverage problem, they're going to get into trouble the next time. My concern, that is the area in which I'm focusing my remarks today, and in fact most of my research and work in Washington now, is on once they get into trouble, try to prevent their failure from creating a knock-on effect that will clog the plumbing of the financial system and cause a macroeconomic recession. But I don't think, we can do the best we can to prevent them from taking too much risk, but I don't think we're going to be able to foresee or look around corners and see how they might be able to do that the next time. We want to allow them to fail, not bail them out, and prevent that from getting hit the next place. But you're absolutely right. Yes, sir, with the glasses, the tall man right here.
What's your take on the overhanging outstanding real estate, commercial real estate business, and the option arm resets that come up in 2010?
Serious problem. As I mentioned, the International Monetary Fund has estimated an additional $1.5 trillion in loan losses still to be written down.
That's where that estimate came
That includes.
Because around this neighborhood, you see space available, our biggest.
Well, yeah, there's not quite 1.5 trillion right around here, but but globally, there's a lot more that's going to happen. Fortunately, we're not in the middle of a financial crisis. It should be possible for the banks to recapitalize as they go, and to use the earnings that they're making. You know, some banks are quite profitable now, like J.P. Morgan and Goldman, as you may have read, are just raking in money. Other banks are doing okay, and they'll be able over time to cover these losses. I had a conversation with Ben Bernanke when I was in Washington a few months ago about this issue, and he said, you know, it's not always the case that the assets of a bank are worth more than their liabilities. Although we always learn in the accounts that that's supposed to be true. They often find themselves underwater, but in the normal course of affairs, they can work that out. And that's why, you know, the Fed is there to pump up the economy and keep them going and lower interest rates so that they can make more profits when they're in desperate trouble. But again, in a financial crisis, that doesn't work because there's a run on the bank, and we find out that the assets are worth less than the liabilities because we actually liquidate both sides of the balance sheet, and there's not enough to cover the liabilities.
So the answer is basically wait and see.
Wait and see, that's right. And I'm relatively optimistic, so I'm not telling a scary story on that front. Yes, sir.
Yeah, Citicorp had a $100 billion off-balance conduit.
Yes.
And you had the same thing all over in Europe. The question is, that's been cleaned up. And how far is the risk pendulum going to swing back to conservative asset allocation and so forth?
Well, it has swung. These off-balance sheet conduits have been cut. Yeah, oh, sorry. The gentleman has asked me, what about off-balance sheet financing conduits for the large banks like Citibank, which had a lot of it? And now that we are in a situation where we understand that these are dangerous, I think that's the premise, will the pendulum swing to the other direction? And instead of having too much leverage, will we be too conservative? Which is, in principle, a danger because, you know, if you require too much capital to make a loan, then it'll be too expensive for people to borrow on their credit cards, to buy homes, to buy cars, for factories to hire workers. You know, we don't want to slow down the economy to zero by restricting the availability of credit. We need to allow some degree of flexibility to the financial system. So my view on that is the government doesn't need to worry at this point too much about its desire to reduce leverage at the banks. The banks have already taken care of that to a great extent. They've become very conservative in the way that they're making loans. They no longer have these off-balance sheet financing conduits. There is no longer a business which is called securitization. It's essentially disappeared for the time being. So very few loans are being made. Well, I might take issue with that. It could come back in a good way. But there's many fewer loans. Voluntarily, the financial industry is making very few loans relative to its capital compared to what it was a few years ago. Now, eventually, the government, if they start to roll up the leverage again, the government's going to have to step in and make sure that they don't roll it up too fast. But I don't think we need to worry about the government putting the brakes on too hard. Maybe the financial industry has to figure out how to get more efficiency on its own for the time being. Okay, I've got a gentleman back here with I can't read anything on your name card.
I'm confused by when you're talking about the banking system. What is the banking system? If you take the regulated banks, as I understand it, only about 25 or 35% of the savings were flowing through them. Most of it was flowing outside. Now, some of it was obviously these off-balance sheet vehicles. But so far, everybody's talking about the banks. One of the real problem may be out there in the unregulated, the classic example were mortgage brokers that were unregulated totally, creating a lot of the subprime mortgages. Could you comment on that?
Sure.
What is the banking system today?
Sure. About 25 years ago, the ratios were reversed from what you said. The banking system was about 2/3 of lending, according to the flow of funds information from the government. And now it's about 1/3 of lending. And the rest of it is what's called the shadow banking system, which is what you're referring to. And these are non-bank conduits for getting credit to consumers, home buyers, factories, private equity, hedge funds. And it happens through many different kinds of vehicles, the most important of which, in terms of volume, was securitization, which allowed banks to originate loans but not continue to be the lender, but rather pass the loan to another investor in a package which is quite complicated called a collateralized debt obligation. And that business was, as you know, at the very core of the cause of the financial crisis. And again, continuing the theme of my answer to a previous question, I'm taking it from there in my study to the disaster in the dealer banks. But you're absolutely right. We need to fix that system as well. In fact, the private industry, I think, is going to fix, that industry has disappeared for now. Securitization is, there's no issuance for now, except where it's supported by central banks, particularly the ECB and the Fed. But on the private side, it's just going to start dribbling out new collateralized debt obligations again. And I think it's good if it's done well, and it looks like it's going to be done much better. We don't have to worry about them making too many wild and reckless loans now because investors don't want those kinds of shadow banking collateralized debt obligations very much now. They have to be done very safely in order to attract investors. There's going to be improved transparency standards. There's a system that's come into place in the residential mortgage-backed securities market for improved transparency. There are some ratings issues we could talk about another day, long, complicated story. But I think that industry is going to come back in a much healthier and safer way. And it'll be another 20 or 30 years at least before it gets us into a very serious problem again. Yes, right next door. Yes, gentlemen.
Listening to you, I had the impression that what went wrong was that people in charge had the bad judgment. They were taking too much risk. And part of the answer to that, I heard, was, well, better regulation to prevent them from making mistakes. That in itself bothers me a bit.
Do you want me to comment on that one? Or?
Maybe it's two questions, but I'm going much further than that now. Back a few years ago, the Enron scandal led to the demise of Arthur Andersen. And there are, I think there are about a dozen people who are in jail now because of that. When AIG Financial Products was guaranteeing banks to the tune of tens of billions,
350 billion,
without making adequate provisions, is that just bad judgment?
First of all, I agree with the premise of your question. There's no way that we're going to pass regulations for smarter managers, better managers, more diligent managers. Nothing that I've suggested would have the government go in and say, one individual is not qualified, another individual is better, or you'd better shape up and be smarter. The government is not going to be effective at that. It's the same thing as trying to outlaw fear and greed. It's not going to be an effective thing to pass a rule to say that investors shouldn't be afraid or they shouldn't be greedy. What we need is a sound system of financial infrastructure. We need the plumbing, the valves, the pipes, the joints, the tubes, all have to be very robust, safe, big diameter. They can take big gushes of risk, of capital flows without breaking. And if one of them breaks, it's not going to bring down all of the rest. That's what I'm personally working very hard for in the area of derivatives, for example. These clearinghouses that the gentleman up here was speaking about. In the area of repurchase agreements, I'm proposing a utility which would be just like an ATM machine. You stick in your securities, you get out your cash. There's no discretion. And you have to put in the right amount of securities per unit of cash. So these are not rules that the government is going to impose on managers to say, please be smarter, or don't be evil, because that's not what the government does well, and it's not effective. But rather infrastructure. That's what I'm all about. One more. Yeah. Gentleman right over here.
On the other side of it, you mentioned the conservative nature of banks and the lack of securitization. I'm involved with a company that owns a bunch of other companies, and they're middle-sized, 100 million to roughly $1 billion in annual revenue. And they're, part of their structure is they've got levels of debt that are coming due every 2 or 3 years. And the issue is many of those are healthy companies, but they can't get the credit. So they're not only being hit by the general slowdown in the economy, consumer confidence and everything else, in both on consumer and industrial side, but they're now having to come up with cash that may not be on their balance sheets. That's the comment. The question is, when is that going to turn around?
Interestingly, I have a PhD student who just left and has now taken a job at Boston College, who's done research on as you move from recession to growth period in the economy, how banks tighten and loosen their lending standards. Now, this is not just they charge more interest rate or less interest rate. They actually restrict credit more during recessions than during expansions. And he's shown quite conclusively that that exacerbates the losses, because it's at the peak when you're providing loans freely that you're building up this immense quantity of debt that's going to have very low recovery in the event of a recession. So the story that you told is not just the companies that you've witnessed. It's in fact very common across the economy. And in fact, bankers are polled by the government periodically, I think it's either monthly or quarterly, for how conservative their lending standards are. Now, this is a subjective poll, but nevertheless, they're also consistent with exactly what you described. And so if you want to know when this is going to end, wait until we have some more economic growth. The banks are a little more flush with capital, and then you'll see lighter lending standards. And let's hope it doesn't go too much beyond that they'll adopt not as weak lending standards eventually as they did in 2004 and 2005. Thank you very, very much for the opportunity. This was great. Thank you.